I've been coming to Tanzania for 15 years. The regulatory, thank you, doctor in the room, our commissioner, have improved tremendously. I think I can say almost as world-class regulatory system, but this is not enough. They know their business. What is important is for you to know their business. It's not enough that the regulator knows what they want to regulate. It's important to the regulated organization appreciate the regulation. So this is something that I realized lacking in Tanzania for growth. Growth is not only regulation, growth also financial awareness in the public. And this is I don't want to use the word mistake, but this is the shortfall of the regulation and the industry together, that there is no proper financial awareness about insurance, proper financial education about insurance among the private sector. Maybe it's a little bit more. Among the private sector, the formal sector, informal sector, is zero almost. So this is probably we'll talk about later on.
Okay. Thank you very much. I have one question for you, Mr. Muhanna. From the actuarial perspective, what structural changes would have the greatest impact on increasing insurance penetration, given it in the next 5 years?
Again, actuarial and non-actuarial perspective. I said something yesterday. I was speaking to the ATA, Association Tanzania Employers, and it caused some headache in the audience, especially Social Security organizations were present. And I said that NSSF, the contribution rate is too high. And they didn't like that. Even the minister didn't like that. And I tried to explain. 20% in NSSF and 20% in PSSF are not to be compared. PSSF is one single employer. The employee pays only 5%, and the employer 15%. And that 15% primarily is 5 and 10. 5 to match the employee, and 10 to hold loyalty. The employee stays with that employer almost for the rest of their career. In the private sector, 10% on the employee is too high, and this is why compliance is very weak. There is a lot of things happening behind the scene, employer talking to their employees, lowering their salaries, or not even declaring them to NSSF, and the employee is happy. They are saving 10%. And the employer is saving 10%. Employer has no benefit whatsoever in loyalty in NSSF. The employee can work for CRDB for 6-7 years, and then go work for a competitor, and his benefit goes along. This is unheard of for a very generous scheme. And that generosity in scheme make the life insurance industry to grow slower. Because you go to an employer, tell him, I want to sell you an occupational pension scheme. I say, wait a minute, I'm already financing 10%, and I don't even get any benefit. However, if the contribution rate of the employer goes down to 5% to NSSF, you can talk to the employer and create an occupational pension scheme. And this is why occupational pension scheme in this country is not growing. There are other things you can talk about in Tanzania to grow within the next 5 years. You are lucky, recently we have Islamic insurance companies. The kafil is very, very important, especially in countries with 50% almost Muslims. This is very, very important. I've been working with the kafil for over 30 years in Sudan and other countries in Saudi Arabia, and it picked up tremendously because people feel more comfortable. But all this does not say that insurance will grow. I will very much like to really regulate heavier the broker, the life, right, selling life or pension. I talked to you yesterday and you told me you are a broker and you can sell life and non-life, but by your choice you decided only to sell non-life. But because you are good, other people will sell anything that can sell, and this is the bad thing. Here, I would like to say to the regulator, maybe in my closing remark, to make stronger regulation and have a special license to life brokers or life agents. Thank you very much.
Thank you, Isa. I have a question here, and a note and a question. Would you want to read it?
Yeah, so I'll be Mama's voice today.
Right.
So my voice is not as soft, but bear with me. So Mama Ikongo has asked a question. She used to enjoy, tax exemption on life policies back in the 80s. And see, this is one of the things that sort of, motivated her to, purchase because of that leeway on the tax part. And this question goes to Mr. Muhanna. Do you think this would be another, if we try to engage the relevant authorities, on a way that taxes can be reduced on such policies, do you think this will help in increasing penetration? We're having a discussion with Dr. Komba in the morning around the same topic. Mama anataka kuongezea.
Someone, it is the tax relief on individual policy premium.
Engaging all regulators is very important. I took the initiative personally a few months ago, and I went and knocked at the door on the Auditor General. And I told him, I would like to train you free of charge about how to read an actuarial report, primarily for occupational pension scheme. And then they can appreciate what is being done as far as clients are doing. Yes, engaging TRA is very important, but not in such setup. It should be really on a group setup, technical setup, for them to understand that. Again, I would like to reiterate, tax itself does not hinder the selling of insurance. Certainly the general insurance, certainly the life insurance. I told you I'm going to talk to you about incentive tax from TRA. I don't know if you'll allow me to speak about that.
Just in 1 minute, please. We're running out of time. In 1 minute.
In other countries, life insurance grew only because the tax authority gave qualifying policies definition, whereby employers or employee buying a life insurance for 10 years, as long as they maintain that policy, do not surrender, that premium they pay is tax deduction. That increased the life portfolio of insurance company. That created momentum, and this is why life insurance companies in the West, they own banks, they are bigger than banks because of that decision of what you call tax incentive for life insurance. And the good thing about it, they spread the investment policy across the country. Instead of having one big pension fund with one investment policy controlled by the BOT, and they are lending the government. And if anything goes wrong, and here I'll give you an example, in Lebanon, the government defaulted in their treasury bills. The Social Security gave the pensioners only $7 for every $100 of benefit. People lost 93% of their dollars. That's their savings. However, if you have a spread of insurance companies and one insurance company goes belly up, you still have other companies. This is one example. If you allow me to give you another example. When you have very large fund, it's like an elephant, cannot move very much. What happened in Saudi Arabia, the pension fund is a major pension fund. When they decided as a government to do privatization of telecom, privatization of railroad, privatization of this, where did they instruct? They instructed the pension fund to invest in the stock exchange in these organizations. When the prices went up, any investment manager, what does they do? They sell to materialize the profit. The government intervened, they said, oh, you cannot sell. Because if you sell, you crash the market. You are too big of an investor. But however, if you have multi-investors, then the market is more vibrant. So this is where I say You are lucky that we have, or we are, if I consider myself Tanzania, we are lucky that we have one regulator he's not biased vis-a-vis insurance or pension. He look at the government level as a country, and I hope that will take into consideration. Thank you very much.
Thank you, Mr. I'll give you 40 seconds, Mr. Muhanna, and I would also want you to give your opinion on this. What one policy reform would you recommend?
To look at the needs of the people.
Right.
The needs. In this country, you should be very proud of your culture. I've learned it when I came here, that when somebody dies, his father or his mother, they go to the village for good 10 days, 20 days. Now, if these employees, by law, he's entitled to leave his employment and to go. But if he is a barber or hairdresser, and he goes to the village for 10 days, he lost income. No insurance companies they provide funeral cost. You sell funeral cost policy, life insurance. But not about if he dies and somebody to bury him. But nobody is selling insurance for the extended family's life. If anybody of their extended family die and the guy have to drop his work and go. There are tons of products that you can do so you can grow the market. You don't have to mimic the West. You have your own needs, you have your own particularities, you should be proud of, and allow them to feel that a hairdresser in Dar es Salaam she can leave her shop and disappear for 2 weeks and mourn, and without realizing I have lost my income. So these things that you can do. Please don't ask for benchmarks. Benchmarks are dangerous. Be creative. You have all the tools. And something that you may not know, M-Pesa was revolutionary in Africa. You exported that knowledge abroad. So you can try selling insurance that is cheaply distributed through mobile phone. Thank you very much.
Thank you, Mr. Muhanna. Any other question from the audience before we wrap it up? None? One last question to my panelists before we wrap it up this session. Mr. Muhanna, again, if we meet up again in 5 years from now, and the insurance penetration remains low, who should bear the responsibility? Is it insurers for failing to innovate? Is it policymakers for maintaining unfavorable environment? Or is it the market for failing to build trust and awareness? I would request you to keep it very brief while you're answering this.
I think investors should be educated about insurance. Once investors are educated and that education reflects to the board, they know that insurance is a long-term business and then their investments are correct. Right now, investors put a lot of pressure on management. They don't know anything about, not all investors, but most investors, they don't know much about insurance. And the ones that know about insurance, their background is broking, not risk-taking. Talking about risk, by the way, I assume that I will arrive here and they do not give me a name tag, and so I carry my own name tag. So this is what we call looking forward. Thank you very much.
Thank you very much, gentlemen. It was a very, very productive session. Before I wrap it up, I like to end my panel discussion with an off-table question that is off from what we've discussed. To you, Mr. Muhanna, if you are to choose a place to retire, where will it be?
I hope I will die standing up. So technically speaking, retirement is not in the agenda. I'm 72 years old. My father worked until he was 80, and he died standing up. So I hope I'll do the same.